Today, we are going to talk about a guy named Joe. Now, Joe is 44 years old, has a family, works hard, and is trying to build up his nest egg for retirement. Now, he's been studying personal finance and he recently learned about whole life insurance. When he first learned about whole life insurance, his response was, "No thanks." You see, he had heard about whole life insurance in the past and even had some friends and a family member that had bad experiences with whole life insurance where they felt ripped off and taken advantage of. However, as he continued to study about whole life insurance, particularly the cash value benefit, he learned that wealthy people used it. He learned that corporations have used it in the past and still use it. He even saw that banks, the major banks, put tons of money into cash value life insurance. It's a little bit different than the whole life insurance product, but it is similar. So he said to himself, I've heard bad things about whole life insurance, but it keeps coming up and I see people that do well with money, that already have it figured out, putting money here. And you know what? This is what he said to himself. I've never given it a true, thorough examination. I'm going to take a look at the product and make the decision for myself if it is a fit or not. So he dug into it and he ended up really liking what he learned. After learning about whole life insurance, he said that I want a life insurance policy for the cash value and the following reasons. One, it's a safe place for my money. He learned that his cash value only goes up over time no matter what happens. Two, he learned that he can put his money in the cash value and then he can loan against it. And when he takes loans, he keeps earning interest on his entire cash value. That means money that he has not loaned and also what he's loaned. He said it's a lot like borrowing against real estate, which he had some experience with. And then three, he loved this piece. I can take money in retirement and it's all tax-free. That was a huge advantage. So let's pause there for a second. Pretend that you are Joe. Have you ever looked into whole life insurance? When you looked into it in the past, what I just described, did it sound like that? Or did it look like something that you were not interested in at all? Maybe it sounded like what Joe discovered, maybe not. Maybe you looked at it and said, there is no possible way I am going to put even $1 into a whole life insurance policy. But why are there mixed opinions? Some people love it, some people hate it. Well, the reason for this is because you can get a whole life insurance policy and it can look really, really good, or we can take that exact same policy and it can look really, really bad, where you say this is just an expensive life insurance policy. We'll see an example of a really, really good policy in this video. So here's what Joe said specifically when he requested information about a policy as he starts to look at the actual numbers. So Joe, again, is 44 years old. He's interested in a whole life insurance policy in order to maximize the cash value. He's not interested in the life insurance. He said, I can just get term life insurance if I'm concerned about that. The cash value is what I am interested in here. Okay, great. I can fund the policy with $25,000 to $50,000 per year. He said this after he had done his own independent research. In addition to the $25,000 to $50,000 per year, I have a lump sum of 50 to 60 grand that I want to throw into the policy only for the first year though. I don't know how long I want to pay premiums. I do want some premium flexibility because I don't want to be locked into a big bill. And again, I'm interested in the cash value, and there's two main reasons why. One, before retirement, I want to be able to use this cash value for life purchases. He mentions buying a new car, updating his home. You'll see the reason why is because he wants to add an addition for his parents when they're right around the age of 80. He wants to be able to move them in so he can help take care of them. And then possibly Junior's education. That's the first reason, being able to use the policy. We're going to look at exactly that. And then the second reason, retirement income, being able to take tax-free income in retirement, because you can do that very easily with a cash value life insurance policy. Make sense? Hopefully it does. So a popular question we have here when people hear stories like this is, Why would anyone say this about a whole life insurance policy? I want to put $50,000 per year into this whole life insurance policy. Very exciting, isn't it? It can be once you learn how it works. Here's the answer, the cash value. That's it every single time. Do you remember those 3 reasons Joe had mentioned? It's a safe place to put money. He can access the cash value anytime while it keeps earning interest while he is using it. And then it's got a really nice tax benefit, meaning he can use that cash value tax-free if he does everything properly. Does this make sense so far? As far as just entry level around whole life insurance, why he's interested in the product. Here's what I like to do. When someone provides this information, first I want to confirm what their understanding of whole life insurance is and make sure we fill in any gaps just through education. But he mentioned a couple things with the funding, 25 to 50K per year, and he's got a lump sum. So we're going to build Joe's plan. We're going to loop back to these questions, but we're going to look at 3 phases of Joe's plan. First, we'll look at saving and growing his money. How do we maximize the cash value? Second, we'll look at how he can use his money before retirement. That is for those life purchases, the new car and the home updates. And then third, how does he take income? What does that actually look like? So we'll look at money going in, money being used, loans and repaying those loans, and then also taking money via income and not paying anything back. Making sense so far? All right, cool. So first, saving and growing the money. Joe said this, I could do a lump sum upfront of $50,000 to $60,000. He also said that he could pay $25,000 to $50,000 per year. Here are my questions. First, that $50,000 to $60,000 lump sum, is this the total dollar amount you'd like to pay in the first year? Or is it in addition to the 25 to 50K per year? If it's in addition, does that mean you want to fund, call it 50K over the course of the first 12 months, and then day 1 start with 50 grand? That means in the first year, you've actually gotten 100 grand into the policy. Or do you want to start with a lump sum, give yourself 12 months to recoup your savings again, and then see where you're at and fund the policy further? It's going to depend. In Joe's situation, it's 100K up front. That's what he wants to do. Next, my question, how long would you like to fund the policy? 5 years? 10 years? 20 years? Is it forever? Or is it I don't know? And this question is perfectly fine to ask, by the way. You're going to see he wants to fund it for 10 years. Here's an important piece, company choice and policy setup. This is the most important piece in my opinion. So when I say company choice, I'm not referring to what agent or agency you're going to work with. No. I'm referring to what life insurance company in which your money will be placed with should you go with in terms of putting money into a whole life insurance policy, or what would I do? I would always recommend one of the 4 major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is when we look at whole life insurance policies that have lived the test of time, we've seen policies with those 4 companies consistently deliver strong actual results to policyholders. Meaning not just a good-looking illustration and then see the numbers under-deliver. Not to say other companies do that, but we've seen the proof of performance with those 4 major mutuals, which is why I am very comfortable with them. Next, policy setup. So a question here. When you think of paying money into a whole life insurance policy, do you think of something very flexible where you can pick to pay different amounts every year? Or do you think, I just buy a life insurance policy, I'm told, here's my premium, and I pay it every year? Is it that simple? You can set it up to be very flexible. So here's an example, a little bit of education on whole life insurance. When you pay money into a policy, you can actually choose where it goes. You can direct your money toward what is called the base premium. Let's say you put $1 here. If you put $1 into the base premium, in the first year, you will see, with most whole life insurance policies, 0 of that dollar show up in cash value. With some products, you'll see a little bit of that dollar show up in cash value. But the base premium does not prioritize cash value. It prioritizes the death benefit. Premium dollars buy us life insurance. Next, we've got what is called our paid up additions rider or PUA rider. If we put $1 here, we see that dollar show up in cash value, or just about all of it. Typically, you'll see right around 90 to 95% of that dollar show up in cash value. It does buy you more death benefit. However, the focus for most when they're putting money to the PUA rider, the focus is to grow the cash value. How do I maximize it? So, where would you like to put your money? Here's what most people say. The PUA rider. Some people even say or ask, can I put nothing toward the premium and everything into the PUA rider? The answer to that question is, unfortunately not. Insurance companies do have limits that determine the maximum dollar amount I can add to a policy on any given year. So let's talk about Joe here. Joe, how much is he paying in the first year? Do you remember what we mentioned? 100K. He wants to pay 50K plus another 50K in a lump sum up front. So it's a total of $100,000. So of that $100,000, where is the money going? And we want to make sure we maximize this cash value. The base premium. You'll see that we can drop it to about 10%, which, easy numbers here, 10% of $100,000 is $10,000. So his minimum premium will be about $10,000 per year. Then we've got the other 90% going toward what is called our PUA rider. You're going to see the true minimum is about $11,000 when we look at the numbers, but we get it as close as we can to the minimums that the insurance company offers, the insurance company that we're considering as we look at different options and such. When you add those two together, you get a total of 100K. Okay, so policy setup. I would look at one of the major mutuals and set the policy up with the minimum insurance premium and put as much money as I can toward the PUA rider because that every time will maximize my cash value. So Joe's case, the first year, he's paying $100,000. Second year through the 10th year, we're looking at $25,000 per year. Now, he said $25,000 to $50,000 per year. And something we hear quite a bit when we look at illustrations like this is someone will say, well, I'd like to be able to do 50 because I can. I've got the means to put more into this policy. And my response is, okay, we definitely can do that. However, in your situation, since you are planning on using this policy heavily, what I might recommend to start is, aside from the first year, start with the $25K per year. We'll go conservative in order to keep cash flow available to repay the policy loans. And if you find out that you can pay the loans back and pay 50K per year or even more, because you can go up to 100K per year, if that ends up being the case, you can just increase the funding. With your existing policy, we don't have to set it up that way from the beginning. We build them so you can add more money after you start. So I'd recommend just starting with a lower commitment, if you want to call it that, with the ability to add more, but we're starting conservative, so you have the ability to attack the policy loans. So want to see this, 100K in the first year, and then 25K per year thereafter? All right, let's take a look, because this is, again, the most important piece. Let's take a look here, beginning with the plan. So starting at age 44, his plan is to pay 100K in the first year. The minimum premium, $11,000. This has to do with his base premium. Then we've got another $1,000 going toward what is called a term insurance rider. This prevents what's called a modified endowment contract, which is a taxable event. My point is we've got the minimum amount directed toward the insurance premium in red here, because that builds the least amount of cash value in the first year. Then the rest, we are plowing into our PUA rider. Add red and purple together, you get blue. There you go. 100 in the first year, and then 25K per year through year 10. And we can set it up where we can fund longer, but in this case, we're just going to look at 10 years. Okay, so we've got the funding there. What's the policy look like? Well, first we've got the total outlay. This will tally up all of your annual payments, so you can see the total amount you've paid over time, $325,000. Then your cash value, there's your money column. And then your death benefit. So this example is showing what the policy looks like if you pay money in and let it sit and grow. Just follow the plan. We're going to look at loans and income a little bit later, but where we always like to start is what's it look like if you pay money in and just let it sit and grow, because then when we look at loans and taking money, you can see the impact that it has on your policy. Here is our break-even point, which is when we get our money back. So at year 5, you have paid a total of $200,000 and your cash value is $203 and change. So that's when you are cash positive along with the death benefit. And then here at year 10, or year 11, I should say, look at that death benefit. It drops. The reason why is because we elected to reduce it on purpose, because we're not paying anything in anymore. So by reducing the death benefit, we allow our cash value to grow at a faster rate. What we did specifically, remember that term rider I mentioned earlier? So we've got term insurance that's attached to the policy. We just chopped it off. That's what we did here. Okay, so that's the plan. What was the other thing he wanted to see? $25,000 to how much? $50,000 per year. Let's take a look at that. So here's the same thing, the exact same policy, but funding it with $50K per year. So again, first year is going to be identical because it's the same policy. But what do you notice? More money in cash value. Break even is almost year 4 when you look at it. I would say if he did $100K each year, he'd be right at that year 4 break even point, which would be sweet. One more thing. Let me ask it this way. Do you think that you're committed to this? Like if you said, I want to pay $25K per year, do you have to pay that? What's your minimum? I'll give you a hint. You'll see it in one of these columns where it says minimum premium. So the last example, what do we see? A first year lump sum. And if he said, what's the minimum that I have to pay? Well, here you go. What we assumed here is that you only pay the minimum beginning year 2, nothing into additional PUAs. There's your total payments. Cash value still breaks even. Year 5, that's because of the first year lump sum. But same policy here, just demonstrating what it looks like if we pay less than the plan or aggressively funding it. So what we're going to look at is the option on the far left and see what that looks like when we start using the policy and such. When I say using, I'm talking about his life purchases. Do you remember what those were? The car and then also the home edition. So what do we have here? First, a car. When it comes to taking a loan for a car, so you want to buy a car with your policy, my first question is, when? The answer, 1 to 2 years. Next question, how much? Answer, $50,000. I want to get a nice new truck and I want to make sure I can drive my kids around comfortably. 50 grand should do the trick for you. Would you like to repay it? Because that is optional with life insurance policies. The answer, yes, I'd like to repay it at $10K per year. Now you can repay it however you'd like. You don't have to commit to a schedule up front. You've got complete control in this case, which is nice. So $10K per year is what he wants to do. Let's look at this and then we'll look at the second loan. But the first one will explain how policy loans work. This will be pretty cool. First, we've got our policy. On the left, we've got what it looks like if I just park money and let it sit and grow. In the first year, what do you notice? Cash value is just about $90,000. You paid in 100, you've got that 89,838. This is the same illustration that we just looked at. This is the plan. 100 in the first year and then 25K per year thereafter. What we're going to look at is taking loans, but we're going to compare these two side by side. This way you can see the exact impact that loans have on a life insurance policy. So year 2, we're going to buy that car. We take a $50,000 loan. You'll see it right here, annual loan. We pulled this directly from the illustration, 50K loan. The impact on my policy, my cash value does reduce. The cash value, think of it this way. This is your equity that you have access to. Okay, so when you take a policy loan, you see what it is before and also after. What about your death benefit? 1.341. What's it over here? 1.391. What's the difference? Exactly $50,000. Anytime you take a policy loan, you'll see your death benefit will be collateralized dollar for dollar by whatever that loan balance is. So there's the loan, and then we are going to begin to repay it at $10K per year. So in light blue, we've got your out-of-pocket loan payments, and then in purple, you'll see how much is applied toward the principal each year, and in light red, how much is applied to the loan interest. Let's take a look. 10K per year. There we go. First year, we actually don't make any payments for 12 months after we take the loan in this example. But then the first year, $10,000 loan, $7,200 applied toward the principal, $2,700 and change applied to the loan interest. The principal payment deducts from the loan balance, and as a result, you see your cash value and death benefit begin to come back up. Now, remember, you're still paying it at this point in time. His plan initially was to fund 25 to 50K per year. So his out-of-pocket here is 35K. Funding the policy with $25,000 in premium and PUA payments, and then the rest is going toward the loan. When it's repaid, what do you notice? Cash value is $345, death benefits 1.6. What's it over here? Exactly the same. There's no change. So anytime we take a loan and repay it, what we see is that our cash value is going to be restored to exactly what it would have been as if we never touched it in the first place. The same is true of our death benefit. Sometimes it'll be a little bit different if the policy is what's called a direct recognition policy. Now, that typically does not make much of a difference at all when you look at the numbers, depending on the company, that is, I should say. If you're looking at the big guys, you're usually fine. So there's our value once it is repaid. What about the next phase? So what is the next phase here? Well, before we just jump into the numbers, let's go back. Here we go. So home addition or home improvement wants to move his parents in about 10 years. So when? About 10 years from now. How much will it cost? $250,000. Do you want to repay it? Yes, but you tell me what I need to pay back in this example. Whatever's needed to pay it off in 10 years, really what he wants to make sure of is that it's paid back by the time he retires so he can start taking income from the policy. Now, he doesn't have to do that. He's got the flexibility, but this is his personal goal. So let's take a look. We're going to look at the same thing we just looked at. This is how we build these plans out. So same thing here. There's the home addition. We take a $250,000 loan. What's the impact of that loan? Cash value reduces, death benefit reduces. We want to compare it with the examples on the left. The example on the left drops by about $250,000 when we look at it. Now, we repay it at what's needed to pay it off in 10 years, about $40K per year. And at age 62, what do we see? What's your cash value and death benefit? Exactly the same in both cases. So our money kept on compounding for us. This is a big reason why he's attracted. Now, if you're a numbers person, what I like to do here is see what am I paying in loan interest, because this is money that is going to the insurance company. However, I'm also getting money from them, what I would do is look at a cash value growth column to see how much I'm getting from the insurance company every year. And we've got other videos that do that. What you'll see in this case especially, the earnings are going to easily outpace the loan. And you can always run any loans just to see what the numbers look like. You can flip it, like if you take a loan that's just way too aggressive and have it outstanding for a long period of time, you can see a case where the loan interest expense exceeds the growth. In this case, we're not going to see that happen. But again, we've run the numbers to see that, and we've got other case studies that really break that down thoroughly. But here we're looking at using the policy. What's the main takeaway here? Because I know this is a lot of information. When we borrowed, our equity, which is our cash value, went down. Our death benefit was collateralized. We paid interest to the insurance company, but they continued to pay us interest, dividends that is, on our full cash value, as if we never took a loan. So I'm getting interest on everything, and I'm paying interest on what I use. And when I pay it back, my money's fully restored. That was the main point of attraction. Okay, let's continue on, and we'll wrap this up by talking about income. So in retirement, he would like to see what the policy looks like if he decides to take income when he's 65 years old, 70 years old, or if he starts at 75 years old. Let's take a look. So again, we're going to look at the exact same policy. No changes at all. So starting at age 65, here we go. What is he getting out every year? Down here, 64 technically. In purple, $35K per year. That's how much he's pulling. So $35,000 per year. In light blue, we've got the total amount he's pulling out. So how you can tell, first year, you took 35. Total payments that you received, 35,000. Next year, you took another 35,000. 35 plus 35 is 70. Next year, you took another 35. 35 plus 35 plus 35 is 105. This shows you the total amount of money you received over time as you continue to pull out this $35,000 per year. Make sense? Sweet. So we assumed he's kicking the bucket somewhere in his 90s, but that's how much he can pull comfortably. Got a lot of cash value left over here. That's how much he can pull. If he starts at 65, if he starts at 70, let's defers it for a longer period of time, $48K per year. And then if he starts at 75, even more. Pretty cool, right? And that's his income when we look at it. Now, sometimes what comes up in discussion is the idea of an annuity. Does it make sense? My answer is it can. It depends on one's situation. I hate that answer, by the way. It depends. Like in this case, it does depend. And there's several ways you can fund an annuity. Where we see it a lot is someone will take old money in an old 401k and transfer it or roll it over into an annuity. Where it works well, in my opinion, and where I really like it, is if you just want a guaranteed income stream. So you can give the insurance company a big pile of money, I gotta spell that right, a big pile of money, and they'll say to you, thank you, you have just bought insurance for your money, to say that. I'm not sure if that's compliant. My point is, you give them a pile of money, and they turn around and say, we are going to guarantee you a certain dollar amount forever. Here's how much income you're going to receive. That's typically the type of individual that likes annuities a lot. So let's summarize everything we put together here. Joe is interested in a whole life insurance policy. He's interested in funding a policy first to build cash value. Second, he's going to use the policy for a new car and then also a home edition. We skipped over Junior's education because Junior got a free ride. But he's going to use the policy as of now, again, for a new car and then also a home edition. And then number three, he's planning on taking tax-free income from the policy in retirement. And then 3B, maybe we'll look at an annuity, depend if he feels it's a fit and if he is setting certain funds aside specifically for income in the future. Hope you enjoyed this video. Please let us know your thoughts and we'll talk to you soon. As always, I hope this helps. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.